Imagine this. It's 1792. America is barely 3 years old as a nation under the Constitution. There's no Federal Reserve, no SEC, no CNBC ticker blasting 24/7. Wall Street isn't even called Wall Street yet. It's just a dusty street lined with coffee houses and private homes where a handful of merchants trade scraps of paper representing government debt and bank shares. Suddenly, prices skyrocket, then collapse in weeks. Fortunes vanish overnight. Debtors flood prisons. Crowds gather in panic, whispering about suicide and ruin. Women weep in their parlors as husbands lose everything. This is America's very first stock market crash, and almost nobody talks about it today. But it shaped Wall Street, saved the young republic, and taught lessons we're still relearning in every bubble since. Welcome to the Panic of 1792, the forgotten crash that could have killed American finance before it truly began. Stick around because this story has everything: greed, betrayal, genius intervention, and a hero who basically invented modern crisis management 80 years before anyone wrote the rulebook. Let's dive in. Our story starts right after the Revolutionary War. America is broke. The new federal government under the Constitution inherits massive war debts, millions owed to soldiers, farmers, foreign lenders like France and Holland. States have their own debts too. Credit is shattered. Many think the young nation might default and collapse. Enter Alexander Hamilton, the brilliant, ambitious Treasury Secretary. In 1790, Hamilton unveils his master plan: assume all state debts into federal debt, issue new bonds, U.S. securities, to pay old creditors, create a national bank, the Bank of the United States, to manage money, issue currency, and lend. This is revolutionary. For the first time, there's a real market in government debt. People start trading these U.S. 6% stocks, bonds paying 6% interest, and shares in the new Bank of the United States. By late 1791, speculation explodes. Why? Because Hamilton's system works too well. The new securities are safe, backed by the government. Prices rise steadily. Everyone wants in. Merchants, lawyers, even ordinary folks borrow money to buy more. In New York, already the financial hub, brokers meet under a buttonwood tree on Wall Street to trade. The star speculator is William Duer. Duer is flashy, connected, a former Continental Congress member, Hamilton's old friend and assistant to Treasury. Duer quits government to go full Wall Street. He's brilliant but reckless. Duer teams up with Alexander Macomb and others. Their scheme? Corner the market in U.S. debt securities and bank shares. Here's how it works. The Bank of the United States opens in December 1791. To subscribe to bank shares, you pay partly in cash, partly in U.S. debt securities. Demand is insane. People borrow heavily, on margin basically, to buy in. Duer borrows massively from banks, friends, even the new bank itself indirectly. He buys huge amounts of securities, driving prices up. He promises huge returns. Word spreads, get rich quick. By early 1792, it's mania. Securities prices double, triple in months. Coffee houses buzz with rumors. Everyone speculates. Merchants pawn goods, widows invest savings, clerks borrow from bosses. It's America's first bubble. But bubbles pop. In March 1792, cracks appear. The Bank of the United States tightens credit, stops renewing loans freely. Why? To curb speculation, as ordered somewhat by directors. Duer's scheme relies on endless cheap credit. When loans aren't rolled over, he can't pay interest or margin calls. March 1792, Duer defaults. He owes hundreds of thousands, enormous them. Creditors demand payment. He can't pay. On March 23rd, Duer is thrown into debtor's prison. Panic spreads like wildfire. Securities prices crash. U.S. 6% bonds drop from 25% premium to par or below. Bank shares plummet 25% in days. Brokers fail. 25 failures reported in New York alone in one day. Merchants can't pay suppliers. Trade freezes. People hoard cash. Rumors fly. The government might collapse. The new financial system, Hamilton's pride, is about to die. Crowds gather outside prisons and coffeehouses. Debtors' prison fills. Some talk of fleeing to Canada. Women and families suffer quietly as savings vanish. It's chaos in a tiny market, but for young America, existential. Hamilton gets word fast. He's in Philadelphia, the capital. Letters fly. Hamilton knows if this panic destroys confidence in U.S. securities, the whole funding system fails. No credit, no growth, no nation. He acts decisively. America's first central banker move. Hamilton uses the sinking fund, money set aside to pay down debt. He directs agents to buy government securities openly in New York, flood the market with liquidity, buy at falling prices to stabilize. He coordinates with the Bank of the United States. They lend freely to solvent borrowers against good collateral at penalty rates if needed. Sound familiar? This is Bagehot's dictum. Lend freely against good collateral at penalty rates. 80 years before Walter Bagehot writes it in 1873. Hamilton writes letters, buy bonds, inject cash. He even uses Treasury funds to purchase. By late March, April, purchases total hundreds of thousands, massive then. Prices stabilize. By May, panic ends, market recovers. Duer stays in prison, dies broke years later. Macomb and others ruined, but the system survives. Why forgotten? Because no Great Depression followed, no breadlines. Economy booms in 1790s. Hamilton's quick action saves it. The Buttonwood Agreement, May 1792, comes right after. 24 brokers sign rules under the tree, birth of NYSE. Lessons? Speculation plus leverage equals danger, but smart intervention works. Hamilton invents lender of last resort, proves government can stabilize without destroying freedom. Compared to 1929, too late, too little intervention, Great Depression. Or 2008, bailouts echo Hamilton. This crash shows markets need rules, but also backstops. America's financial DNA formed here. So next time you see a bubble, crypto, meme stocks, whatever, remember 1792. Greed hasn't changed, but smart leadership can. Let's go deeper into Hamilton's world. Alexander Hamilton was born in the Caribbean, illegitimate, orphaned young, climbed through sheer intellect, aid to Washington in war, co-author Federalist Papers. As Treasury Secretary, he was basically America's first economist-in-chief. His report on public credit, 1790, bold. Pay debts at par, even speculators who bought cheap. Controversial. Jefferson hated it, called favoritism to rich. But Hamilton won. Assumption passed narrowly. Then Bank of U.S. Charter 1791, opposed by strict constructionists, but Hamilton's necessary and proper argument won. Securities trading began informally in 1790. By 1791, quotes in newspapers 6% at 25% premium, meaning $125 for $100 face value. Duer, born 1747, New York merchant, made fortune in supplies during war, involved in the Scioto land scam, close to Hamilton, helped draft reports. Duer's plan: use borrowed money to buy securities needed for bank subscriptions, control supply, drive prices higher, sell high. He borrowed from everywhere: Bank of New York, merchants, even foreign houses. By winter 1791-92, interest rates soared, call money tight. When bank refused renewals, Duer's pyramid collapsed. Hamilton's response: March 25th letter to William Seaton, direct purchases. He used the sinking fund commissioners, including VP Adams and Chief Justice Jay, to authorize buys. Injections: about $200,000 plus in purchases, huge liquidity then. Result: by April, prices rebounded, confidence restored. Post-crisis, economy grew, cotton trade boomed, U.S. credit established, borrowed cheaply abroad. The crash was short because action was swift. Unique angle?
This was proto-central banking in a republic fearing monarchy. Hamilton risked political capital to save markets, foreshadowing his tragic end. Today, when the Fed cuts rates in panic, it's Hamilton's playbook. This story is viral because underdog nation, genius hero, forgotten drama, modern parallels. Subscribe for more hidden finance history.